Hello, this is Professor Donna Byrne, and this is an estate and gift tax online module. Tonight we're talking about a couple of exceptions to the gift tax. We've already talked about transfers that don't have adequate consideration. We said that those are gifts, and tonight we're adding a couple of exceptions. So if I can figure out where we are, let's see. Here we go. Okay. So first of all, this is what we'll be doing. We'll be identifying the two different exceptions that apply even though there actually was adequate consideration. And so then we will describe at least one business scenario in which the transfer is not a gift, and at least one support scenario in which a gratuitous transfer is not a gift. And then we'll also look at how the Internal Revenue Code expands on the notion of support. Okay, so review. Generally speaking, for the gift tax, a transfer for less than adequate and full consideration in money or money's worth is a gift, and that means subject to the gift tax. First exception, when it occurs in the ordinary course of business. So if it occurs in the ordinary course of business, not a gift. All right, here is the regulation that tells us this. Now, if you're not used to the regs yet, if you didn't have income tax, that number before the period could be anything. That 25 tells me that these are gift tax regs, as does the next bit, 2512. That correlates with the Internal Revenue Code section, and anything that starts with 25 is part of the gift tax. And then the -8 tells us that it's that part of the regs, so that's like the reg section itself. Okay, so here is an excerpt. However, a sale, exchange, or other transfer of property made in the ordinary course of business, parentheses, a transaction which is bona fide, at arm's length, and free from any donative intent, will be considered as made for adequate and full consideration in money or money's worth. Okay, so that's how we do it. If the transaction is bona fide, arm's length, and free from donative intent, then we pretend that there was adequate and full consideration in money or money's worth, and that of course takes it out of the gift tax. Okay, so one of the things that's fun about doing these videos is that I get to learn about really interesting people. Meet Monroe Dunaway Anderson, M.D. Anderson, and in your casebook this is Estate of Anderson. He and his brother and his brother's brother-in-law got together and they formed a cotton company way back in 1904. They did very, very well. Now, M.D. Anderson did not have children. He was a bachelor his whole life, and he was frugal, he was nice, he was generous, he was the town's most respected citizen. He was the guy in It's a Wonderful Life. And he's the one that the M.D. Anderson Cancer Center is named after. So there were kind of two things that I found interesting here, and I'm going to take myself out. One was that the company was pretty closely held, and so we ended up with just 2 or 3 guys holding most of the stock. Now that means if one of those guys dies, then you've got this big estate and no cash, all you've got is stock, so you would have to sell part of it. The other issue was that, and this is true for many companies, the older executives, as they want to kind of step down, need to create an environment which is good for the younger executives and makes them want to take charge and gives them the same interests. And so we want to transfer voting ownership to the next generation, as it were. Okay, so we did a couple of things. First of all, M.D. Anderson created a foundation, and he was able to then leave part of his estate to that, and that creates a big charitable deduction for the estate. That part of his estate's not subject to tax, and it's the foundation that gave money for the cancer center. The other thing that the company did was they had the older executives sell stock to the junior executives so that the junior executives would have that interest in making sure that the company does well. So that's worth it for everybody. The older executives end up with preferred stock, not voting stock, but still has value. And what maintains that value is having strong leadership coming up behind them. So this makes really good business sense to shift the ownership as you shift the responsibility. The problem for us is that the younger executives bought the stock for less than its fair market value. Now, we know that that means that there was not adequate and full consideration in money or money's worth, and that means that part of that would have been a gift. So this is where that ordinary course of business rule comes in. And the court says, well, it's obvious that the sales of common stock were motivated by the peculiar importance of expert and continuous management to the cotton merchandising business. There was no intent on the part of Anderson and Clayton in selling the stock to confer, nor intent on the part of their vendees to receive gratuitous benefits. No intent to transfer gratuitous benefits. It's not what it was about. So it's kind of fact sensitive, and we're looking at what people intended because we're trying to determine the context. Okay. The question is whether this is a genuine business transaction, says the court. We have found that the sales of stock in issue were bona fide and made at arm's length in the ordinary course of business. And so that means these were not gifts. Taxpayer wins, no gift tax. The estate here was represented by Leon Jaworski, who later went on to become famous as a special prosecutor in the Watergate case. And the IRS was represented by a Frank B. Schlosser. My great-grandmother was a Schlosser. Nah. Okay, so here comes our second exception. So normally when we have a transfer for less than adequate and full consideration in money or money's worth, we have a gift for gift tax purposes. Now, all of you who are getting help from family members to pay tuition for law school should be really nervous about this statement on behalf of your family members. Well, here's the other exception. Transfer that satisfies support obligations are not gifts. And a support obligation could be a legal obligation to support your spouse, your kids, your parents, anyone you have a legal obligation to support. Now, what is support? Well, food, housing, clothing, medical expenses, transportation, education, my personal favorite. All of these things are support. So if you're providing support, no tax consequences. No tax consequences under the income tax. Nope. No deduction. No income if you're on the receiving end. The one exception is alimony, and that's because Congress, in its wisdom, said there should be a deduction for alimony if you want it. And so in the case of alimony, we have a very specific definition. If you meet the definition, the payment is alimony. If you don't meet the definition, it's not. And of course, alimony is deductible and it's income. So if there are legal support obligations, other than that, no tax consequences. So we've got a gift tax case, Spruance versus Commissioner, and this actually, I believe this case is brought after Spruance dies, and they're trying to sort out whether gifts were made. Maybe that's the last case. Never mind. Okay, so Preston Lee Spruance and his wife Margaret Halsey Spruance were getting divorced. Margaret is the daughter of Admiral Bull Halsey. There's a whole book about him, so she's a little bit more famous than her husband. Anyway, in the divorce, there was some argument about how much money was needed to support her and the kids. They have 4 kids. So he transferred, pursuant to their agreement, he transferred about $1 million to a trust. And I think I read that he had about $1.5 million at the time. So this was a pretty hefty settlement. But the trust was to pay income to Margaret and to the children for support and maintenance. And then the remainder, when Margaret and Lee die, would go to the kids. So the IRS said the remainder is a gift. Right? They conceded that the income was not, that the income interest provided enough money to maintain the wife and children in the lifestyle that they were accustomed to, and that meant that it was support, right? So the income interest, not a gift because it's support, but the remainder is a gift. This is just straight out giving the money to the kids. And the taxpayer, Spruance, says, no. This was all for consideration, right? This is the settlement. In our divorce, we negotiated it. We were very, very arm's length, believe me. Yeah. And so this should not be taxed as a gift. The court says, well, yeah, okay, if you want that treatment, then you would have to prove that all of that stock in the trust was necessary for support, or that it was to satisfy the wife's property interest. Now, that remainder to the kids cannot be part of the wife's property interest because she's not getting it, right? It's going to the kids after she dies. We do have a deduction for gifts that go to the wife. So if this is going to the wife, we could get out on that. But that doesn't help us with the remainder. Or if you can show that it's all for support for the kids, because he does have a legal obligation to support his minor kids, and if this is support, not a gift. Right, so that's what we're going for, but this is really just a future inheritance that that's being set up pursuant to the divorce, but nevertheless, it's just a future inheritance, and so that's exactly what the gift tax is for. It's for taxing those inheritances that we transfer over early. Okay, now, why would we stop with minor children and spouses? Well, Congress said, yeah, let's not. So 2503E excludes payments for educational expenses or medical expenses for anyone. They don't have to be your kids. They don't have to be your relatives. If you are in a place to do it, you can pay the tuition of everybody in a law school class. How cool would that be? The only catch is you have to pay directly to the educational institution or the medical provider. So, can't just pay out scholarships. But 2503 takes that concept of support, which included medical expenses, educational expenses, and it expands it by making it apply to people for whom there is no legal obligation of support. And I believe that this is the end of this video, so I'll just leave you with this beautiful picture of an educational institution deserving of your current and future support. Thank you for watching.